Daniel Gross, Moneybox columnist for Slate, says no one in the industry complains when markets are irrationally optimistic, as in 2003 to 2006. Volatile and irrational markets are nevertheless real. Market price was okay on the way up. What's wrong with it on the way down?
Here's an important distinction to make in the difference between the type of market that exists on the way up and the type of market that exists in the current market we're in. And I'm not going to say that every down market is the type of market we're in today, but the market that we're in today is a distressed market. There's not a normal amount of buyers and sellers. In fact, there's very few buyers. So on the way up, the economic value of a particular security, as determined by the present value of the future cash flows, are very close to the market value or where I could sell that particular security. On the way down, or more specifically in today's market, the economic value of a particular security is very misaligned with the exit price or what I could earn or receive from a potential buyer of that particular security. So marking to liquidation value or marking to market is not accurately reflecting the economic value of an asset on a particular institution's balance sheet in today's distressed market. And one more thing along the lines of the distinction between market value as defined as exit value versus economic value. Think about a normal asset or a typical asset, such as a home, a car, a piece of jewelry, a brick of gold. Every asset that I've just named, in order to have value, requires a buyer on the other side of that transaction. In other words, if I'm going to monetize the value of that asset, I have to have a potential buyer. So ultimately, by definition, that asset is only worth what a potential buyer is willing to pay me for, in a normal market or a distressed market. The distinction I want to make is the difference between these typical assets that I've described and a bond, because a bond is a cash flow. It's a series of cash flows. So for me to realize the economic value of a bond does not require me to sell that particular security to a potential buyer in a normal market or a distressed market. In other words, if I never sell that security via the future cash flows that I'm going to receive in the form of principal and interest payments, I'm ultimately going to realize the economic value of that particular security.